This is our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. And today we are talking all things financial markets, as we always do. We got a couple of interesting items on the agenda. I've got my small cap of the week, and a little spoiler alert here. It is the most interesting small cap I have looked at thus far while doing this segment. I think we started this segment a little over a month ago. So done 4 companies. This will be the 5th company today, and it is pretty interesting. I think, Brett, you'll be hopefully interested to hear about it. Brett is also going to be talking about Nike's, I don't want to say disastrous, but maybe underwhelming quarter. The stock dropped 20%, and there's some news we can discuss there, and maybe whether or not we will ever invest in apparel. Kind of remains uncertain for the time being, but a little housekeeping items before we get to any of that. We go live on YouTube, typically Thursdays at 10:30 a.m. Pacific time, 1:30 p.m. Eastern time. We are doing this on a Wednesday this week because tomorrow is the 4th of July, so we want to give each other a little bit of time off for that. So anyways, if you want to ask questions, go ahead, look up Chit Chat Stocks on YouTube. And you can check us out on Thursdays live at 10:30 a.m. Pacific time. But we also record this and put it up for the podcast player of choice. So Spotify, Apple, wherever you get your podcast. And before we get to any other topics, I want to talk about our friends at Public. If you trade options, you've got to ask yourself, why wouldn't you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your option trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So don't change your strategy, change your platform, and see the difference in your bottom line. That's no commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. Public.com. This is paid for by Public. Investing options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. Where do we want to start this week, Brett? Nike's disastrous or underwhelming quarter?
Yeah, let's start there. I think that'll be quite fun. I'd say welcome in everyone. Maybe another housekeeping item as a 4th of July special. I did a stock research report on Coors Light, or no, not Coors Light, Molson Coors, owner of Coors Light and Miller Lite and a few other brands. So go check that out as you're drinking some nice beers on this 4th of July Independence Day as you're listening to this. Let's see. First name, blah, 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 blah. Yeah, we'll talk. Let's talk about Nike. Get some people in the comments here asking questions, and we'll get right to it.
Yeah, we already have a comment here that says, I thought Brett loved investing in apparel companies. So if you're new to the show, I'll just say, Brett is not a fan of investing in apparel companies. They can be fickle, sometimes difficult to telegraph. It's hard to know what the future is going to look like for apparel since trends and habits can change so quickly. And we kind of saw that this quarter with one of the most popular, well-known apparel companies in the world, Nike. Do you want to go through some of the numbers, or do you want me to highlight some of them?
I mean, I can go through, give you a little break here. Let's look at Nike here. I mean, I think the big thing is that sales declined year over year, and we're supposed to be getting through this COVID bullwhip. There was some good charts that FinChat puts up for all the different geographical and product segments that they have, and essentially everywhere for Nike, the sales are trending in the same direction, which is down by low single digits year over year, and it has been looking like that for the last few quarters. And the other thing I remember, I can't remember their exact guide, but I think they believe or they're guiding for fiscal year 25, which I think started in the first quarter here, or excuse me, the second quarter of this year, this calendar year. They're guiding for a drop again. So maybe it wasn't smart to buy this thing at 50 times earnings back in 2021.
Yeah, sorry, I'm just sharing my screen here. We're looking at some of the numbers. This is annual, but if I click over to quarterly real quick, you can see, yeah, it's been really, ever since 2022, it's been a pretty difficult go of it for Nike. Sales are down. I think it was a little over 1% year over year across the board. I mean, this is a business that largely has just been kind of treading water for 5 years now. And I remember like we looked at this, uh, the science of hitting that Substack. Our friend Alex Morris writes it, and he covers Nike really thoroughly. And he basically went through some of the old analyst day projections, and they missed across the board on all their growth projections. And then people tend to just kind of sweep that under the rug and forget about it. But then they put out another set of optimistic projections, and it looks like they're going to miss those again. So it's like, I think people don't necessarily hold companies' feet to the fire when it comes to those analyst day estimates. And especially for a company like Nike, where you almost have this like, oh, well, it's so stable. It's such a good business purely because it has been. There isn't, it's been an onslaught of competition. There has been, I don't know if I'd call it brand deterioration, but they've made this push to direct to consumer and try to cut out a lot of the wholesalers in the process. And I wonder if that's ultimately hurting the business, hurting distribution.
Yeah, that could be a part of it. I also think there's new competitors. You got Hoka, you got On, or what is it, right? Isn't it called On? The
Yeah.
ticker's ONON. People seem to be liking those. It's really hard to tell. I think we have one comment here that makes sense a bit as well. Um, so from Ryan says, Lulu and Nike is the replacement cycle for shoes and workout clothes increasing, giving quality improvements. Think iPhone life extending. Possibly. I also think how big can this business really get, right? It grew for 30 straight years almost. It was such a powerhouse. You have the embracing of the Jordan shoes and how much of a hit those were, and then using that across a variety of different sports to attract athletes, be the ones that pay up for these top athletes, get the deals with the teams, get the deals with the athletes, and use that as your advertising and create a moat. But I think the internet, some of the stuff might be changing that, especially with the continued rise of the YouTube, Instagram, whatever influencers, right? Lululemon's done well with that, and I think with
Social
Nike,
shopping.
yeah, the social shopping type stuff. But for me, I kind of go when looking at these, and this is why I don't like apparel in general. Is I go, why is Nike struggling? I have no clue. I have no idea, and it seems so uncertain to me that that's what makes me scared about it.
Exactly.
I did see even another one. There was a lot of smart people pitching this company called Delta Apparel. Forget what brands they owned. I think it was the Salt Life brand and a couple other ones that was more Southeast focused. And I think they were pitching it over the last few years as kind of a small cap apparel play. They just filed for bankruptcy. So it's it's tough out there. It's hyper competitive. There's an interesting, I think it was from a Stratechery interview. There were some screenshots posted about that from a while back where when you have on an online marketplace, say you're on an Amazon style one, I know they're all slightly different, but you have the blocks or the squares of say 12 things you're looking at, and you searched black running shoes. You get 12 listings. They look very similar. You can look at the reviews. And if you have a similar review for something that costs $30 less, well, if you don't really care about the brand that much, you might be switching. And that's the power of these online marketplaces. And yeah, I don't
Yeah.
think they have much power in their supply chain versus customers, suppliers, whoever, how they have to sell through. I remember Apple and Nike. I think Apple still does this because they're so large, but I think they both made a push not to sell on Amazon because they didn't want to get commodified back in, I think it was 2017, 2018. I forget the exact details of the story. Nike, I think, is getting hurt and having to maybe go back to that. Apple's been fine, but I think that shows that Amazon, places like that, have a lot of power.
Yeah, I worry for the same reason you do, and I avoid apparel for this reason is it's so hard to diagnose the actual underlying issues. You look at a business like Nike, okay, clearly there's some struggles going on. The sales haven't grown for the last 2 years, and the question, anytime you look at a business that's struggling, I love setups where it's like, oh, okay, it's trading at like the cheapest multiple that it ever has. What's wrong? And you try to get to like the root of the problem. And for like a Paycom or a Snowflake or some sort of software business, you can typically get to the reasoning. Maybe it's multiple reasons, whatever it is, and you can kind of parse through. Okay, do I think this is gonna impact the business long term? Is this something they can fix? Is this something they can turn around? Can a new management team or new strategic directions kind of help profitability, whatever it is? With a retail business, no one knows. Like you just don't know what exactly is going wrong. And so,
Yeah, and
yeah, or sorry, not retail, but apparel specifically. So, for the same reason as you, I don't love it. The other thing is Nike still is not that cheap.
I was surprised. Yeah, what are they in a 60% drawdown? And maybe you have FinChat uploaded, but I think it's still like a PE of 20, right? Something like that. I think it was around
I'll
20,
pull it
which is
up one sec.
yeah. And with the market at a PE of close to 30, people can say, well, it's cheaper than the market, but I think that's a little dangerous game to play. It's still yielding, I believe, less than short term treasuries, which is part of the, yeah, what do you got there for us?
EV to EBIT is
We'll just get
still
a,
18.2 times.
yeah, so probably right around short term treasuries. So do you think there's growth there? Do you think there's uncertainty there? You have to weigh that versus the risk free rate you get with that short term treasury, at least right now. Uh,
Yeah. You know
I
what?
think
You know what else? The day after Nike had its report, stock dropped 20%. One of the board members bought $227,000 worth of stock. His name's Bob Swan. He's like a prior CEO of Intel. Now, it's a decent increase in the position size for him. Like, I think he increased his stake in Nike by 14%. But sometimes I swear, I think like the board gets together and go, all right, one of us is going to have to do like kind of a signal buy. Like, who wants to take it this quarter? Like,
yeah, to stem the bleeding.
it's,
Yeah, I don't unless a CEO that is or a founder is loading up or something like that, or the CEO is taking a huge position. I don't think those are much of an indicator at all.
yeah. And I don't know. I think a lot of the, almost most of the time, especially when it's something like this, where he's former CEO of Intel, this person's rich. He's on like 4 boards and he bought $200,000 worth of stock. Come on. Like, that feels like a signal buy more than a okay, I truly believe in this business.
Yeah, and I think it's an example here. You look at that earnings ratio. When we look at apparel, yeah, I really don't like investing in them. I had a tweet that a lot of people agreed, a lot of people disagreed. That I said never invest in apparel. Yeah, people talk about, hey, don't be absolutist. Sometimes there might be an opportunity out there, but I think it's a good rule of thumb where I want a big discount of what I think the earnings multiple might be, or what the trailing one is, or what I think it can be in 1 to 2 years if things go right. With apparel, I probably need something like a 10 times earnings ratio with a good chance, if they succeed, for strong revenue growth over the next 3 to 5 years. An example of that might be Lululemon if it gets a little cheaper. It might be that today. Honestly, the forward multiple might not, it depends. We'll see how they do. They seem a little bit more attractive than Nike given the growth potential since Nike is so big. Another one that interested me a while back was Revolve Group, which seemed that it was trading at a very cheap multiple, but again, very uncertain with the apparel industry and how they have to do the online play the online game with uh, basically a millennial and Gen Z women's clothes. Anything else on Nike, Ryan? Are you out? Are you in? Are you
I'm out.
interested at all in this stock?
I'm out. I'm out. I'm not interested. I mean, it's just one that's hard to like. Growth will never be that fast for this business again. I mean, it's just a mature business. It's in an industry that I don't love. Actually, probably one of the industries I hate the most. And I just have no sense of where this company is going. Like if you have truly no sense of what growth this business can generate, you probably shouldn't be in it. And that is me in this case. Maybe there's better apparel analysts out there, but it is not me. I want to. What about you? Any interest?
I'm out.
Yeah. Okay. Figured. The I knew you wouldn't like it as much. Let's go. My small cap of the week. How about that?
Sure, let's do that. Yeah, and I also have a good segment for people as a little tease here. It's what did I call it? 5 small caps that are up 100% year to date. Some good, interesting lessons from that, I think. But yeah, let's hit yours first. A little small cap week, earnings season. I think is this the bottom of the trough between earnings season? There was absolutely no news, so we kind of had to make stuff up on our own, especially with the holiday weekend in the United States.
Yeah, that's all right. I think people probably appreciate it more than just us rambling on about random headlines. Maybe something a little more thorough. Yeah, it is probably the trough in terms of earnings. Banks are probably coming out soon, though, right? Would be my guess.
2 weeks or maybe the end of next week. I actually don't know, but yeah, at least within 2 weeks, we're gonna start getting financials.
Because
Get the
everyone
juices flowing
loves
again.
everyone
What?
loves when we just talk bank earnings for a whole show.
Yeah, I think their price to book's cheap, and I think that net interest margin's stable. Oh, we'll see. Okay, exciting stuff. But yeah, you have a small cap of the week here, Ryan. Nobility Homes. I'll load it up on FinChat in case you want any screen shares.
Yeah, definitely do that because there's some interesting charts here. And typically with small caps, you're going to get real lumpy results. That has not been the case for Nobility Homes. So I actually came across this initially through a screener, just looking for like cheapest companies that are also growing. And it showed up, and I kind of dug in a little more, looked up the ticker on Twitter, found some old write up from a guy named Adam Willick, who I actually love his writing. His blog, I think, is called Pound the Rock Investing, which is a nice title for a blog. It's a football reference, American football reference for anyone who doesn't know. Um, but here's what he says on Nobility Homes, just as kind of a description. He says Nobility Homes is a manufactured and modular home builder located in Ocala, Florida. The company has been operating since the 1960s and has shown plenty of resiliency, as have most modular home builders, having recovered very nicely following the Great Recession and experiencing only a few years of modest operating losses without increasing the share count or taking on new debt. This, if you look at the results around 2005, 2006, they started to earn a ton of money, as you might expect, because it was very easy to finance homes. And then it went from 2006 to 2009. They went from $60 million in revenue to just $12 million in revenue in a matter of 3 years. So a huge drop in performance. But they've just steadily climbed ever since. Since 2009, revenue is up, I believe it's about 11.5% annually. And I think unless we've got another great recession coming or there's a bunch of home loans that aren't warranted, it's probably a little more stable this time around than the GFC. But
One can hope. Yes. And
yeah,
I got the operating earnings loaded up here. It looks like we went from 1.3 million in 2014. Then it climbs. Little peak in November 2019 as their fiscal year, I think, is there. Peaked again November 2023. But now we're at about 10 million last 12 months. And yeah, it's been slightly lumpy on an earnings basis, as you might expect for a home builder. But hey, 11 million earnings in the last 12 months. The long-term trajectory over the last 10 years has been high. And I'm seeing at 11 million in operating earnings, Ryan, and maybe I'm stealing the punchline from you here, but EV 70 million, pretty cheap
yeah,
potentially.
it's a $98 million market cap. They've got about $30 million in net cash. The enterprise value stands at roughly 70. And like you said, around $10 million in operating earnings, around $10 million in free cash flow. The free cash flow conversion is quite good. So at least normally, sometimes they'll have like one-time inventory things, but that's more of just a timing issue. So around $10 million in earnings, which has consistently climbed. So yeah, 7 times EV to earnings. And it seems like an honest management team. So here's more from Adam Willick. And keep in mind, this write-up was in 2018, but he says Nobility Homes sells Nobility, sells homes via retail to customers and wholesale to independent dealers. Both sales channels have the same gross margins, around 17 to 18%. The majority comes from retail. It says the model is interesting and unlike other manufactured home builders in that Nobility builds to order homes as opposed to building models, storing and displaying them at their retail centers, and paying to store the associated inventory. So, not quite as much working capital issues there when you're building homes for people that have already committed, either put a down payment down or kind of signed in the bottom line and is ready to buy the home. It says Nobility is run by the father and son team of Terry and Tom Trexler. Both get paid around $300,000, I believe. It was like 200 base with a $95,000 bonus. That was like the 2018 figures. But either way, I mean, 300K, business doing $60 million in revenue. Not that crazy. It might be a little high, but it's nothing horrible. And then it goes on to say Terry founded the business and owns 53% of the shares in addition to Tom's 10%. Gabelli's small cap fund owns another 14% of the shares. I'm not sure if this is still up to date, with their proportion increasing over time. Hopefully they also see some uses for the cash and will nudge management in the right direction. So they've got a lot of cash. It's a management team. It's run by a father and son. It's been in the business for quite a long time. They seem very conservative with their cash. They don't seem fixated on like growth at all costs or returning a bunch of the cash to shareholders. I'm sure they have some scars from the GFC, so they want to hold that cash buffer. But I think they're to the point where they could probably start to use a little bit of it in buybacks. They are trading at one of their cheapest EV to EBIT multiples in quite a long time. I think a lot of that is just people worried about the forward affordability issues for modular homes. So it's one where there's obviously going to be some lumpiness with the home, the real estate market in general. Any cyclicality there will be reflected in the top line and bottom line for Nobility homes. But run well, cheap, and steady growth. A lot of that is purely from population growth in the Florida markets that they operate. So it seems like there's some tailwinds here, and it seems like a well-run business.
Okay, so they have the exposure to Florida. I think people are probably concerned. That's probably the narrative out there, that there's been a lot of oversupply in Florida, at least in the near term. But as you mentioned, they're in their little niche. What do they call it? It's not mobile homes. It's
Modular or manufactured housing. But keep in mind, this is
cheaper stuff, right? For more starter or
it's anywhere from $30,000 to $130,000 homes. So
okay, so that could keep them insulated from the potential Miami bubble that people have been speculating about. Whether or not it's true, that could help.
Yeah, and keep in mind it's build to order, so it's not like they build a ton of homes and then they're going to be sat there with all this inventory waiting. The other part that's nice
seems interesting.
These are modular, right? So this is sort of just a manufacturing business, right? You're not buying land, so kind of helps relative to other home builders there. So yeah, I like it. Going to do more digging. Would love to get in touch with the management team. It seems like they're probably pretty accessible, seeing as it's just like a father-son combo.
Do we get them on the show, though? Because there's been a curse of anyone that comes on our podcast.
That would be a private discussion.
Yeah, exactly. I think I'm interested. I looked at the shares outstanding down. I don't think they bought over the last 2 or 3 quarters, but I haven't looked closely. But it seems like it went down from, it was like 4 million to 3 million, so pretty good buyback program that was consistent for a while there. And what interests me is, if you say here we have a 50% ownership stake from the father, I believe that was, and then 10%. So combination family maybe owns like 2/3 of this business, and you have a Gabelli fund that adds on to maybe 75% of the total. This could be a candidate where everyone gets concerned about, especially if you're kind of trying to chase the index of, well, who's going to buy my small cap stock or who's going to buy my micro cap? Well, if you have 75%, say, insider ownership who isn't selling, and you have a buyback program, well, that's how Dillard's turned into such a big winner, and this might be a much higher quality business than Dillard's.
Yeah, it is. Dillard shows up in every screener I do, like every buyback screener I do, and
Exactly. If
it
there's no
just kind
one
of doesn't
left,
interest me.
if there's no one selling left, that's what you have to be looking for. And I think one of the keys I look for nowadays, because of the flow issue with index funds and everyone being in S&P 500 index funds with small and micro caps, unless it's a growth one, like a high growth one or something along those lines, more of a speculative one like a Rocket Lab or a Rivian or something like that, I want a buyback program because that helps take advantage of a potentially persistent undervaluation.
Yeah, the other thing that I saw um, following this up was I believe Adam Willick spoke to the management team, and they didn't seem that ambitious about like deploying capital like crazy, catering to the funds that own the stock and trying to just like buy back a bunch of stock. When funds get frustrated with that and start selling because they aren't able to uh, realize the gains in a short enough time frame, that's kind of an opportunity for the individual who's willing to wait it
Can
out.
be, yeah. hmm I agree. I agree. Definitely interesting. I'm interested in this one for sure. Gonna take a look at it. Why don't we, Ryan, go to our next segment, which I'm calling 5 small cap stocks that are up over 100% year to date. So this is going to be our pull out segment. This is going to be our clickbait headline saving for the YouTube clip, but I think it's going to be a fun screener. I found some interesting companies and some maybe case studies on when you can find a stock that's a potential hunter bagger or something that it could go up by a lot within a year. Obviously, you can't bet on that happening, but these are the ingredients for that sort of outcome. So I did a screener on our friends at FinChat, which we'll talk about more later during this segment. And I had 3 criteria: year to date performance greater than 100%. And then I excluded biotech, energy, pharma, and healthcare, basically stuff that I don't understand and stuff that will have some wildly changing price movements. And I didn't want really much pre revenue stuff. Then I just did market cap between 500 million and $1 billion because I don't want any of the tiny stuff that can just fly around like crazy. And there's about 8 of them. I chose 5 interesting ones. Ryan, you can maybe pull up any sort of charts you want while I'm going here, but we don't really need to. First up, I was very surprised to see this, is Root Insurance. Do you remember this one?
Yes, like vaguely.
The,
I thought it was a scam,
no, I
if I'm
guess
not
not. They're doing
mistaken.
it's no, that would be Metro Mile,
Ah, so
which
what does Root do?
Root is essentially Lemonade but car insurance focused. So they say we're going to be leaner than the old organizations. We're going to be focused on mobile data. We're going to be focusing on providing a better offering to younger customers. And they're up 416% year to date. Smart car insurance startup trying to use better analytics. If we look at some of the revenue, I basically can look at their first revenue line item there. Uh, you can see why the stock soared, right? Because premiums went nowhere and then they finally started to gain some momentum and revenues just absolutely soared. They were right around they were losing money on a net income basis. And people probably worried that, their loss ratios were terrible, blah, 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 blah. People are like, okay, your loss ratios are over 100%. That's an unsustainable insurance operation. Well, that's moved really significantly in the right direction where we're very close to break even now. So people like that, you have soaring revenue along with expenses getting better. And if you look at that stock chart, Ryan, yeah, I got totally bombed out. And it went from trading at a price to book value this year below 1, and today now it trades at a price to book value above 5. So I think it's a good lesson in a stock going from very undervalued to overvalued that you can get in the small cap world. You have something that the narrative was terrible on it. Like if we looked at that, we'd be like, it's one of those SPAC insure tech companies, just nothing. I don't want anything to do with this. Second, it was unprofitable and switched to break even, which is a huge difference for people that are, thinking that the company might be distressed. And second, the starting valuation was quite low right before growth started to accelerate. Quite interesting.
Yeah, I've looked at a number of companies where they they need to get to profitability, and you're kind of questioning whether or not they're going to be able to do it. And especially if you don't know the company super well and you're kind of just looking at it from the outside in and maybe looking at like the trailing profit margins and all that, it's easy to pass on it. But if they can make that switch and not kill the business in the process, it can lead to completely outsized returns. You see it with Root. I mean, they haven't officially made that switch yet, but they're certainly getting there. Um, would you touch this?
I don't know. I think right now, probably not because it's gone from undervalued to probably overvalued, and the price to book is above 5 for an insurance company that hasn't proven it can be that profitable, and I'm not sure how much they can grow, and I'm not sure how much if they start growing, the legacy operators can come after them. But I did read a fantastic Substack back in before I think it was right after the first or excuse me, the Q4 earnings when the stock started to take on this move and go up 400%. This guy wrote up, and I'm sorry I can't remember his name, but if anyone wants it, DM us or whatever, we'll put out the link to that. Basically said, "Look, this is a distressed stock. The market cap's super cheap. It's trading at a discount to what if they had some consistent loss ratios that were as good as the legacy guys. They're trading at a discount to what their premiums are of what a typical car insurer is. They're starting to grow again, and it's so cheap that he said it was and people probably laughed at him at the time, and he even wrote in this article or sorry, I don't know if it's who it is, it was an anonymous account. They said, "People are gonna laugh and say I'm too optimistic, but this is the potential of a 100 bagger. You get 10x growth from the multiple expansion, and then you can get 10x growth from fundamental growth." And it looks like so far they're really on that track because it's up 400%. So,
Yeah,
got that multiple expansion within a year.
yeah, I totally agree. Yeah, people look at hundred baggers and they think they were these bulletproof investments, but you like
Gotta start out distressed.
majority of hundred baggers, yeah, they came at a super cheap multiple. You look at NVR, who is kind of one of the iconic multi baggers. Norbert Liu wrote them up. They were coming out of bankruptcy, like, and
Yeah.
then they had this new model that where it was like the land option agreements, and people thought that was going to help them like reinvent their business, or that's what Norbert Liu was pitching. I'm sure people just shrugged it off, like, okay, this is a bankrupt, this is a bankrupt shitco. Good luck with that.
Yeah. All right. Stock number 2, Sezzle, which is a tough name, I gotta say. Sezzle. Stock is up 315% year to date. Here's what it says they do on their website. Quote, Sezzle is on a mission to financially empower the next generation. Sezzle's payment platform increases the purchasing power for millions of consumers by offering interest-free installment plans at online stores and select in-store location. Sezzle's transparent, inclusive, and seamless payment option allows consumers to take control over their spending, be more responsible, and gain access to financial freedom. So, buy now, pay later, Ryan. And financials, unsurprisingly, when we look at them versus Root, they flipped to profitability this year. So, I think there was a huge narrative against these buy now, pay later players. Maybe Sezzle was under the radar. People just tossed him at the bucket, and they've actually flipped to profitability and done maybe a little bit better than the big players. And they began the year at a price to gross profit of just 1.5. So I think the lesson so far this year is if you're searching for stocks that could potentially do quite well, or could be these ones that go from hated at a low valuation to gaining some momentum and being a really good investment, is you want to start with one, or sorry, you have to have a thesis of them going from unprofitable to break even or maybe generating a little bit of profit, because that can change so much from the narrative out there.
Yeah, this one, I guess, buy now, pay later at its core can be a profitable business. I frankly don't see how it's all that different than just a credit card. But if you're able to convince consumers that it's a better proposition and you're able to underwrite successfully, like, you can probably make a lot of money from it. I guess it's
Yeah,
more of
and
just like how you can convince consumers.
yeah, and if we look at them, let me share the screen here. Um, they went into a big drawdown. They're actually still technically in a drawdown if we look at their max chart. So again, it's not the easiest investing to find these stocks, and it makes sense. High risk, high reward. These are, obviously, we don't know any of these things. If you dabble into this, definitely make sure you diversify your positions because a lot of these are going to go to zero. That's the reason that they go up so much is that they're priced for zero. But we have a small market cap, $500 million today, and I want to look at the operating income here because essentially, yeah, why don't we just do quarterly to even it out? If we look, they were unprofitable and they've inched their way to profitability. Last quarter, 19 million. Uh, I mean, looks pretty good to me, right? But the thing is, for me, I can't really get confidence in the what you call it, Ryan. Like anything around buy now, pay later. I have no confidence in any sort of durability in this business. Where Root, maybe there's a potential there, but that's an existing operation and they're hoping to improve on it. Or sorry, an existing sector, car insurance that they're hoping to improve on. Where buy now, pay later is almost a whole new category that they're trying to disrupt entirely a legacy system, which to a point, maybe Root is trying to disrupt them, but I think it's a little bit different. And yeah, we
Yeah.
see today it let's see, went from a PE of quite low and they were barely earning any money to a PE of 40 today. And why don't we talk about,
Let
before
me,
we move on, our friends at FinChat. Ryan, do you want to give the little pitch there for our mid-roll ad?
yeah, I mean, this is one that we shamelessly promote all throughout the shows because we actually use it all the time. And it's kind of just embedded as a part of my research process nowadays. So if you have checked out FinChat, if you want to check out FinChat, you can get all your segments, KPIs, you can get a complete research platform there. And if you're interested in any paid plans, first of all, you get 2 weeks free. So try it out. If you end up liking it, you can use finchat.io/chitchat to get 15% off any paid plan. So go ahead, check it out. It's finchat.io/chitchat. I also want to take a second to mention our friends at Public again. Earlier in the show, you heard us talk about the investing platform, public.com. That is where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public. Investing options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. Brett, before we get to the remainder of your list, I do want to take a sec to answer some questions here because I think it's good to kind of sprinkle these in throughout. Tyler asks, how would you define your circle of competence? What industries do you feel you know well?
Consumer goods, except for maybe apparel, but there's certain things within consumer goods I like. I think I can understand industrials fairly well and financials. That seems to be what I like to write about. I might be forgetting some stuff. I know that consumer internet gets tossed in with technology, but basically anything that the consumer interacts with technology as well, I think I can understand fairly well. And if we look at my portfolio, that's kind of how it plays. Financials, industrials, and consumer. Anything consumer. What about you, Ryan? I'm assuming it's similar.
Yeah. I wouldn't say I thrive in any specific industry. Like that I feel like I have an edge over everyone, but I know where I don't have an edge. Biotech would certainly be one. Um, Insurance I struggle with. I just have it's really a different type of business to analyze financially. Um, so insurance, biotechs, trying to think of the other one. Software, I think as a category, I like it's fairly understandable. Like you said, consumer goods, anything that's consumer technology, I feel comfortable with. I'm probably forgetting something. Financials
There's
are easy.
pharmaceuticals and healthcare.
Yeah, anything pharma, anything healthcare, it's just something I haven't really taken a deep look at. Anything come like oil and gas, it's just a pass for me every time, frankly. And maybe maybe that's the opportunity for all the oil and gas investors. Um, but yeah, it's I tend to write off certain categories pretty quick. Financials, they can be a little more intimidating, but once you understand the metrics, it seems like pretty uniform throughout. You can get a pretty good understanding, especially with banks. You just got to understand, where's the money coming from? Where is it going? What do you think of those two categories? And do you trust management? So I think those are probably the categories I like the most. Do you want to keep going with your small caps here?
Sure. All right. Number three, New Scale Power Corporation, up 248% year to date. They are a leader, well, quote unquote leader, in small modular reactors. And it looks like this is something around the AI electrification and energy increase play for the United States. Company's basically pre revenue, barely generating any, and they're burning a lot of cash. Valuing this one is obviously difficult, but if you look at the narrative around energy usage with all this AI stuff where they're projecting that electricity and energy usage is going to grow in the United States for the first time in a few decades. Well, maybe they're going to need more nuclear reactors, and NuScale could be one that provides that. But this is not one that really excites me. It's kind of just, I don't know, if you could predict there's going to be a AI narrative that translates to a second order effect on energy and electricity and the utilities, maybe you could have bet on this one, but it just looks like a shot in the dark, and this could just be a short squeeze and people playing around with it. I didn't get too excited by this one at all.
Yeah, this does not excite me. I mean, it's
Okay,
a
next one
$900
though.
million
Oh,
dollar
go ahead.
company and whatever, like $15 million in revenue.
Yeah. Let's see. We have a question here from Tyler. Says, "Do you guys think coal or natural gas might make a comeback given AI energy needs? Maybe, but I don't know what AI demand is going to be in 3 years, so I would not want to make that bet. A second order effect bet on something that I have no knowledge about doesn't make sense to me."
Agreed. Agreed.
All right, this next one is going to excite you, Ryan. I think it's called The Real Brokerage, up 179% year to date. Here's what it says they do. The Real Brokerage is revolutionizing the residential real estate industry by pairing best in class technology with the trusted guidance of an agent. We provide a digital brokerage platform for agents while working to build a better end to end home buying experience for consumers. Up 823% since 2020, revenue growing 119% year over year since June 2021. And price to gross profit is still, I said just 10.5. It's right around 10, which isn't crazy expensive for a growth company, but also not crazy cheap. Is this a legit compounder, Ryan? Did we maybe discover something interesting?
Potentially. It's something I got to look at way deeper, but just off the top of your head, would you know what metric to kind of use here? Gross profit, would that kind of be the
Gross
big
profit makes
indicator?
sense. Yeah, it looks like they're not any sort of weird insurance thing or seems like a standard software business.
Um, then gross profit has grown at a compound annual growth rate of 161%. So, yeah, this might be kind of an early stage compounder. Is this the one of the five? I guess you're going to talk about one more here. Would you say this is the one that has you the most intrigued?
Yeah, because Root, I get why it worked, but I don't have any confidence in those SPAC management teams, and insurance startups are risky. Although I get why it worked this year. I get that was an interesting play, and it's just so overvalued right now. Or I shouldn't say overvalued. The expectations embedded in the stock price are much, much higher for growth than they were at the start of the year just because it's up 400 and something percent. But let's move to the last one, FTAI Infrastructure. I can see Ryan already rolling his eyes. We got another AI play here, up 139% year to date. I'll do another quote from their investor relations page. The company primarily invests in critical infrastructure with high barriers to entry across the rail, ports, and terminals and power and gas sectors that, on a combined basis, generate strong and stable cash flows with the potential for earnings growth and asset appreciation. And it is an affiliate of Fortress Investment Group, a leading diversified global investment firm. So I think it might be similar to a Brookfield entity where they spin off different segments and you can publicly invest in whatever you want. It looks like this is another infrastructure AI play. They even put it into the title. They've had steady quarterly revenue growth, but this thing trades at 12 times gross profit as an industrial type thing, as an infrastructure thing. I don't think this one interests me whatsoever. Um, and I worry that people are getting ahead of their skis with these kind of infrastructure reshoring plus AI energy needs. and you're going to bid up a stock 140% because of that, do you have any confidence in what the actual number for energy and electricity generation is going to be in 3 years? What if we see huge efficiency gains on the chips and stuff like that? Whatever. That's another that's a little bit of a ramble here. Ryan, what do you think looking at this one?
AI beneficiary play, I will pass.
Thumbs down.
Yeah, it's gonna be a thumbs. It's what do they say on Shark Tank? For that reason, I'm out.
For that reason, I'm out. Yeah. Well, I think that's a good little segment there. Again, check out finchat.io/chitchat. Get a little discount on any paid plan. And if you use our code, don't worry, you're not just getting a discount. It helps us out growing our business as well. Ryan, any final thoughts looking at these small caps? Because I think there's some lessons here, but curious what your thoughts were.
I guess it kind of cemented my belief that like you got to be extra picky in small caps because I mean, you presented five. I thought four were generally not that attractive, and one was potentially more attractive in the real brokerage. So definitely got to be extra choosy. I do like this question from Tyler though. He says, I mean, we've talked a lot about micro caps and small caps today, so I want to. He kind of asked, do you think micro cap might be harder than large cap because you are buying your shares from informed retail investors, whereas there are uninformed retail investors in large cap? Maybe, especially in drawdowns with a lot of large cap. Yeah, I think there's probably unwarranted sell off where people just all of a sudden the stability is not there and they don't really know why. They don't want to track it, but so that they're out. The thing with large caps, just generally speaking, and it's not always the case, but there are a lot of inherent advantages to being bigger. You have more resources, you can allocate more money to marketing. Now, it might make you slower, there might be more bureaucracy, but especially in like a retail type of business, you can be you can outcompete your competitors because simply and oftentimes simply because of your size. You can offer better costs, you can get better rates from suppliers, all that. The economies of scale thing is real. And so that just kind of is a nice safety valve when investing is at the end of the day the business is going to have a better chance of growing into the future than some of these micro caps. That's kind of why I would say if I were choosing between micro caps and large caps, if I had to, I'd say there's a little more safety in the large caps, being that they just have more resources.
Yeah, I think that makes sense in a vacuum. But when we're looking at one thing I maybe disagree with this question here. So again, let me read it again. Do you think microcaps might be harder than large caps because you are buying your shares from informed retail investors, whereas there are uninformed retail investors in large cap? So I think what is wrong about this is that in large cap, the uninformed retail investors are never selling because they are in index funds and it's buy, never sell unless we're rebalancing, right? So I think if you look at, I'm not a index fund bubble truther. There's some good arguments around that, but I don't know I really don't have a strong opinion on it. I just think it's interesting. But if you look at the valuations of large and mega cap stocks today, they seem to be going higher than any sort of small and micro cap. They're outperforming. They're doing better, and there's that multiple expansion. I think within the large caps, yes, there might be less informed investors, but that's actually worse because they're not indiscriminately selling. They're only indiscriminately buying, and index funds are only gaining market share year after year after year. Honestly, for short sellers, I think low volatility large caps such as Nike, where people kind of fall asleep at the wheel, can be good short candidates. When on the other hand, in small and micro caps, what I do enjoy is that the flows are falling away from them. Active investors who go into these are getting redemptions and they're year after year after year, they're losing money to index funds. And if you get one that is a good capital allocator, cares about shareholders, and is going to buy back stock or pay out a dividend or whatever, I think that can be a huge advantage. But yes, you can get stuck with a stock that goes nowhere in micro caps and small caps for a long time if management doesn't really care about I wouldn't say care about the share price, but care about returning capital to shareholders or taking advantage of a low valuation.
Yeah, the other thing you get with micro caps oftentimes is, and I think this is Seth Klarman who said this. Yeah, I think it was a Seth Klarman quote, but he's like, some of the best situations you can get is when someone is forced to sell something for reasons other than like company analysis. So maybe they need liquidity. They need money for their own personal life. They have to sell because there's redemptions in their fund. You get that a lot of the times with micro caps because they can't just sell into the open market. They have to sell in chunks, that kind of thing. And you can that's why you see sometimes with all right, I looked at Nobility Homes recently and there was like a bid filled 15% lower than the quoted price. Like that's part of
Yeah.
it. And so if you're the person that's got those orders open, you can get them filled at major discounts.
Yep, that does make sense. And Ryan, before we move on, we got about 10 minutes left. Have we hit all the advertisements?
Yes, all our
Okay, cool.
friends and sponsors we have discussed, our friends at Public, our friends at FinChat. Thank you for your unwavering support of our show.
Yeah, yeah, definitely, definitely. Okay, we have one. Any thoughts? And this is a question here from the listeners. Any thoughts on Ulta? We talked about them a while back.
I
Anything
like it.
changed for you, Ryan? I know we kind of put it a little bit in the watch list slash could be interesting. You get seem to be interested in this as well. Any updated thoughts? You buying? You researching it for your next research report episode?
Not for my next one. I don't own it, but I do like it. It's I think this could be when we look out over the next 10 years or so, assuming that the multiple kind of sticks around what it's at and people kind of treat it like a low growth retailer from here on out, I think this could be a real share cannibal. That they've opened the buyback up, the authorization, and they seem to be putting real money towards it. It's one where I think the narrative is maybe a little off base. They've got, if you look at like the automotive aftermarket parts businesses, the AutoZones, the O'Reillys, these are businesses where they have like a consistent tailwind that just kind of helps propel them a little bit because cars on the road continues to grow. People looking for cosmetics in the United States, that is a growing market. And the more and more people care about social media, I think the more and more cosmetics will be purchased. So it seems to me like Ulta's got kind of a tailwind there. And it's one that's quite resilient to online competition.
Yeah. All right. I think it should be the one. Well, spoiler, Ryan's doing a auto parts retailer for his next stock research episode, but the one after, I think you should do Ulta. Seems like a lot of people are interested in it and could be an interesting opportunity as well. Let's see. Tyler says, have you guys looked at LVMH? Yes, we did a full episode on them at the end of 2023, and we did a luxury overview one. Go look at our episodes from December 2023. We did a ton on luxury companies.
I don't know why, but LVMH just doesn't interest me.
Too big?
Yeah, probably. I mean, the multiple wasn't crazy. It's really well run, but there's just something about it. You know how there's certain stocks where you just shrug your shoulders, like I'm just not going to be a part of it. Maybe it's like the whole I don't feel original in buying it. Sometimes
Yeah.
I know there's no points for originality in investing, but sometimes I like to find an undiscovered company, make it seem like there's a little more intellectual stimulation for me in finding something that's less covered than
Yeah.
LVMH.
I agree. I agree. We have Ryan, different Ryan in the comments saying, "Is Brett looking to outsource his research?" Well, that's what we do. Ryan does a research episode, I do a research episode, and it helps each other out. And hopefully, that's the whole point. We help out the listeners as well with their research, providing free research. I think it can be quite valuable, and we appreciate the people that listen. And yeah, as a note, if you didn't see it in your podcast feed or YouTube feed, we did release today as we're recording this, but as you're listening to this a few days back, the Molson Coors episode. I think that one was quite interesting. Definitely would say wouldn't be opposed to people adding that to their portfolio, but for reasons we get into in the episode, there are some other stocks in the sin category that we like a little bit better.
Speaking of Molson Coors, tomorrow's the 4th of July. What uh, friendly consumer thing will you be doing tomorrow to benefit America's economy? What will you be
Yeah,
buying?
that's exactly right. Well, my house is doing a barbecue that I live at, and we made a Costco run. Gotta say, it was extremely busy, and it was in the 100. We had food and drinks for the barbecue. I gotta say, we were pretty diversified across the beer categories. Coors Light, Budweiser. We decided to get one of every of
Wow.
everyone.
AB InBev, one of the only consumers left, I guess.
Yeah, exactly, exactly. Budweiser, Coors Light, Bud Light, or not Bud Light, Rainier, some seltzers for the ladies, right? Gotta have some of those in there as well. Oh, and then some Mexican beers. So we did some of that. So we helped Costco's numbers quite well, I think, with one trip, 2 carts, lots of stuff. I think this is always a good weekend for that company.
Yeah. I mean, just the food, consumer goods in general. I imagine 4th of July is a hot time for that. Someone
Yeah.
says only Coke or Coke Zero for me. I like that. All right. Coke. Coke, I'm sure they don't need any extra consumers, but they've already got pretty much the whole world captured. I guess that kind of makes me think, would you ever invest in Coke?
At the right price? Yes. But I treat it more like a tobacco stock than people maybe would like it to be. I think it's closer to tobacco and nicotine than people think it is.
Would you feel more inclined to buy Coke or Pepsi?
Pepsi's more diversified into snacks, but I think Pepsi, given that snacks diversification, has more Ozempic risk, if you get what I mean. So there might be more uncertainty this year than there were with them than I thought there were, a couple years ago.
Fair, fair. Someone says Booking Holdings versus Southwest Airlines. Do you have
Oh
a
yeah, that was
preference
Tyler. He
there?
put that in the the Twitter machine. Did you know that they trade at the same multiple, Ryan? I mean, if
That I
it's at
did
the
not.
same multiple, Booking over Southwest, easy, because
Yeah.
Airbnb and Booking at the right price are very easy buys to me, because travel's going to grow a little bit faster than global GDP. As people reach a certain level of income, they have an more of their income goes to travel because they have their basic needs set. So if the world becomes richer, there's going to be more travel. Airbnb and Booking are going to do well, but they're not hyper growth businesses. They're more of durable growers, I think. So buying at the right price makes sense. Hey, I I think next weekend I have a Booking trip. It works quite well. You're gonna go through Booking, and yeah,
A
it's
Booking trip in America. One of the only
I
consumers.
know, I know, no Airbnb. Yeah, it was already a hotel, so you know.
You decided not to go direct to the website?
No, I guess not. It worked. It worked. I think what happened is I did some searching in that area on like a map. I kind of like searching on the map for different areas, and then I was like, "Hey, this is it." Go through Booking. It was easy, I guess.
Interesting. I
Yeah,
think Booking I think Booking's in a good position. You know, I think market share will skew more and more towards Airbnb in the States, but they really seem to have a hold of the European market. Same with us, really, most places internationally. They are well protected, kind of with a moat in its network effect. You know, people really rely on Booking, the hosts do. Um, and yeah, like you said, just tailwinds galore. Travel's going to grow. The number of people that can afford travel will likely continue to grow. If
yeah.
Southwest lowers costs and gains market share the way they have, it's going to continue to grow.
I will say this: if global GDP grows, it will grow. So, yeah.
Yeah, this is interesting. Booking might have a great summer, the Olympics and the Euros.
They might, but that's something that gets priced in, you think, right? You'd think?
There's got to be some analyst
That's
at some
pretty
huge
obvious.
investment bank that's tracking every single number with some alt data around,
Yeah,
with a bunch of satellite imagery on all these popular hosts.
exactly, exactly. Yeah, we have someone here talking about Expedia. Maybe we're forgetting about them. Maybe there's an opportunity there if they can become the third player, but it's harder to do.
Expedia has one of the most egregious corporate offices maybe in the world.
Yeah.
They have no
So
business. They bought up some huge corporate office in probably one of the most expensive areas for real estate in the world in Seattle. And it is enormous. And they just really had no business doing that. They're not of that
yeah, I
size.
agree. I agree. Yeah, we have a comment saying, "Did you see the Wells Fargo Chipotle bowl size research?" I did see that.
No, what was it?
Someone in New York City, you know how there's been the complaints about Chipotle shrinkflation?
Yeah.
A Wells Fargo analyst went to 75 locations and measured the quantity of the same exact bowl size, and there was actually quite a bit of volatility in it. So the thesis was room for something like lower volatility in bowl sizes for Chipotle and how it could be a growth factor. So interesting
Oh,
research.
man.
That's some good research from an investment bank right there.
Give that analyst a promotion.
Yeah, give that analyst definitely earned their bonus. But maybe one more topic here, Ryan. You want to talk about Tesla deliveries, or do you want to close things out?
No, I don't know. There wasn't that much to talk about, right? It was basically in line. But so it
Oh,
was
in
in
line,
line.
but they've reduced it. Did
Yes,
you see that chart?
it
Yeah,
was in line
you're
with
gonna go.
expectations, but expectations for deliveries, the delivery estimates has just come down and down and down and down over the last year and a half. So it's whatever. I guess you could say it was priced in, but uh, when you just leak what your deliveries are going to be, like closer and closer to the quarter, and you just
And make it
shoot,
5% lower.
yeah, shoot just a little under what you know they will be. Like, I don't see how anyone reacts to that news.
No, but they should add $100 billion in market cap because of that. I think seeing that makes me want to hide in these high dividend yield tobacco stocks and just go to way treasuries, high dividend yield tobacco stocks, and just wait for this nonsense to end.
Tell you what, I took a road trip actually using a Tesla this weekend. Drove 5 hours both ways in a Tesla. I don't know. It was fine. It was a car.
It's a car, yeah.
It's a car.
Yeah,
It's
I
nice that
know.
you don't have to pay for gas, but
Don't you have to pay for electricity now or no? Or do
yeah,
you?
I
It's
mean
kind of weird. Some people don't.
it's still a discount relative to
Yeah.
gas, obviously.
Okay.
But there are a lot of states are instituting taxes around having an EV. Like you have to pay an annual fee to have an electric vehicle because they're not generating as much tax income on the gas. They're losing gas volume. So I don't know. Maybe there'll be cost parity over time.
Look, yeah, I saw that their market share has gone down to like 50%, which obviously they're still the dominant player within the EV space. But given where the stock is, it's priced like they're going to be 100% of global market share. So since that's happening, especially if we look back to 2021, where they're still in like what a 30% drawdown from that high, at that then it was priced in like they're going to take over the world. And I'm interesting to see they have this new narrative about the Optimus bot and the AI research that they're reportedly spending $10 billion on, and the robo-taxi service that is supposedly going to launch. I'm interested to see what happens with that. We, as always, will be following for fun from the sidelines, not touching this either way.
Yeah, agreed. All right, you want
All
to
right.
wrap things up here?
Yep. Thank you for everyone for joining. Had a fun one. I think more people honestly are free to watch on Wednesdays. So maybe we'll stick with this one. But we're going to try to find, given with Ryan and I's schedules, the same time to go for these podcasts. So as it's been about 10:30 a.m. Pacific time, 1:30 p.m. Eastern time on either Wednesday or Thursday. It's historically been Thursdays, but we'll give everyone an update and we'll hopefully lock in the same time going forward. Let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, and we'll see you next time.